Welcome back to Tax Summit Week 2021. This session is how a global minimum tax will affect your business, industry, and the economy. At this time, I'm pleased to turn our call over to our first presenter, Ayanna Martinez. Ayanna?
Thank you, Allison. So with you today is Mario Vandenbroek, partner in our international tax practice in our RSM Netherlands office. And myself, Ayanna Martinez, Senior Manager in our International Tax Services, and I'm in the Washington National Tax practice. And the learning objectives for today's session will be to identify global tax trends which affect U.S. multinationals and to articulate the impact global minimum tax will have on your business model. So with that, I'm going to turn it over to Mario, and Mario will take us through the first half of this webcast, and he'll be talking about the global minimum tax from an international perspective. Mario?
Yeah, thank you, Ayanna, for that quick introduction. Yes, today we're going to talk about international tax rules, and what we want to do is talk about the international tax rules from a non-US perspective and from a US tax perspective. And I'll kick it off talking about the new rules from a non-US perspective, and Ayanna will do the same, but then from a US tax perspective. So obviously we live in very interesting times, and what I thought would be interesting to talk about is, of course, Pillar 1 and 2, but I would like to kick it off a little bit with what has happened over the last 5 years, and maybe even a little bit before. But I think what we have seen is that a sculpting and a resculpting of the international tax landscape. It really all started in 2013 when BEPS 1.0 was introduced. And I think at the time, a lot of tax practitioners were uncertain of its impact. And obviously about 8 years later, now into BEPS 2.0, I think we all realize that it has had a significant impact, but it seems like there is much more to come. So, I could have posted a long list of international tax changes, and probably it would go beyond this page. So what I try to do, because we have limited time, is just to focus on 3 key areas of development. Now, one area of development is, in my view, tax transparency and the type of behaviors it seeks to encourage or discourage. The second is tax integrity or tax governance and sustainability. I think there's a lot of discussion on, the impact of tax governance and the environmental side of tax policy. And of course, the third item is all about, how are the new international tax rules, are they going to address, the digitalization of the global economy? Now, with the first item on tax transparency, we've really seen that it has become a trend, and of course my background is from a European perspective, but I've been working a long time with U.S. companies, also working in the U.S. for several years. So there is a real overlap between what I see between Europe and the U.S., but my key focus is on Europe. And what we've seen in Europe is that there's there have been a lot of changes around tax transparency, and I think it really started years ago with country-by-country reporting, kind of requiring internationally active companies to share their global footprint, to make it easier on tax governments and tax authorities to exchange information. Now, over the past few years, you've seen different types of increased transparency. One that stands out is, of course, on the tax rulings, and I think the latest has been DAC 6, basically the disclosure of tax structurings, not just aggressive tax structuring, but really, all kinds of tax structuring that have been advised on by intermediaries or have been implemented by companies themselves. Through that required disclosure of information, we've already seen that governments throughout Europe are exchanging a lot of information, and as a result, we see an increased activity around tax audits. And of course, the whole COVID rise and the need for governments to increase their revenues have played an important part in that tax transparency. Now, and I think there are a couple of things coming, like public country-by-country reporting, so taking it to another level. We've also seen countries like Mexico implement DAC 6, so we also see that tax transparency is something that is spreading throughout the world. Now, with tax transparency, obviously it offers governments more information, but because of a lack of resources on the side of the government, the real administrative burden is placed on internationally active companies or intermediaries. They have to provide a lot of information, and of course it's questionable what is going to be done with that information. Now, we have seen already an increased level of audit in countries like Spain and Italy and even Poland. So we already know that that information will be shared and used to increase tax revenues. The second element that is kind of relating to transparency, but also what's going on in society, is around the theme of tax integrity and sustainability. We've seen a number of internationally active companies already coming up with corporate responsibility reports or tax contribution reports showing to society and obviously their stakeholders and the public consumers what kind of tax policies they have implemented. And we've also seen a real shift in behavior. Even though certain tax structures are allowed by law, more and more companies have to think about should we do it? So even if it's allowed, is it something that we should be actually considering or implementing? Now, and of course, with the whole discussion on ESG or sustainability and environmental issues, it also becomes important, how boards and directors are behaving around tax policy. And a lot of people will say, well, we are not into tax evasion or avoidance, but what kind of policies have you installed to actually prove that? And how have you trained your people to make sure they can make the distinction between tax evasion and tax avoidance? Now, why is this all important? Because we see a shift in the appetite for tax structuring. So again, the traditional rules were really focused on fixed presence and enabled a lot of tax structures focused on boxes and legal entities. And throughout the years, especially under the influence of the digitalization of the global economy, governments really found out that the rules, the old rules, really did not apply in an efficient manner, and really had an impact on the way they were able to tax profits. One example is that you have a lot of customers, buying services from these companies, but these companies, they don't have presence in a lot of jurisdictions. So how do you tax those profits? Now, I think that not only because of the digitalization of the global economy, the rules have changed, but also because of the consensus reached between governments amongst each other. Because I think for years there was a lot of tax competition, and that's still the case. But because of BEPS 1.0, you already started to see that countries were able to work together. They reached consensus in an unprecedented manner, like never seen before. And I think the latest example of that was shared on October 8th when Pillar 1 and 2 were officially accepted by a large group of countries around the world, 136 to be precise. So we're going to talk a little bit more about the impact of the new rules and what is going to happen. But before that, I would like to know from the audience, what is currently the key international tax development that you're dealing with? And of course, there are several, but I think you can only select one. So I'll give you a minute to select one of the key items before we move on to the next segment.
And while we're waiting for those responses to come in, I do want to advise the audience that if you do not see the submit button on that slide window as you're completing that poll, simply scroll down within the window to click that submit button and submit your response.
Okay, I'll just give you a few seconds and then we'll move on. I think we have 90%, over 90%. Okay, so let's see what the results are. Well, I think the other is of course the big component, but let's just focus on what is specific here. Transfer pricing stands out, of course. But I think it's also very interesting to see that a lot of people in the audience are actually dealing with tax transparency, which doesn't come as a surprise to me, as I described a little bit earlier. Potential Pillar 1 impact or Pillar 2 impact, I think that is in the starting phase. So maybe that's a good segue into my next item, which is obviously Pillar 1 and 2. Now, if you look at the purpose and the scope of BEPS 2.0, I think there are a couple of items that stand out. Of course, the inadequate ability of the old tax rules to respond to the digitalization of the global economy. And I think this was already mentioned in BEPS 1.0 in 2013, when actually BEPS 1 talked about we should do something about these digital developments, but the OECD really did not have a clue on how to do that. And they had to wait for years to come up with a solution that we're going to talk about. Of course, everything has been based around BEPS on consensus. I think it has taken a lot of years for governments to come together. Of course, we had, the bilateral treaties, in some cases multilateral APAs, but this is something that has not happened in a long time. Now, the third pillar or the third element of the BEPS 2.0 scope is a two-pillar solution. So the first pillar really focuses on the largest companies in the world and provides an approach to reallocate profits and taxation. And the second is, of course, the second pillar is, of course, on a minimum tax. Now, and the last item, which has also been stressed by the European Commission, is, of course, that, and probably that explains why some things have accelerated as they have, is, of course, to also generate revenues in the post-COVID recovery, governments needing money. And, of course, as part of the agreements, a lot of revenues were at least budgeted. So we'll have to see whether that actually holds truth, but it's a very important reason for the acceleration. Now, if we look at, where are we with BEPS 2.0 and what does it really mean? Now, of course, it's still in a draft phase. The plan is that more guidance and legislation will be drafted in the rest of this year and next year. because as of 2023, it has to enter into effect. So that's a really ambitious time frame, but I think also the budgetary reasons and probably public scrutiny make sure that for now everything is on track to be effective as of 2023. Now, if you look at the scope real quick, Pillar 1 is really aimed at the largest companies in the world, defined by a turnover of 20 billion euros and a profitability in excess of 10%. And Pillar 2 relates to multinational entities that meet the 750 million euro threshold as determined on the BEPS Action Item 13, with country-by-country reporting, but also the ability to for countries to actually apply a broader scope to companies if they don't meet the threshold of 750 million euros. So that is an interesting aspect. It could have impact on a lot of different companies. Oh, sorry, go too quick. Now, if you look at Pillar 1, you know, and it's a little bit technical, but the essence of Pillar 1 is that, you know, they talked about the 100 largest companies in the world, and I don't know if it's really 100, but even it's still the largest companies in the world, you know, with a global turnover of 20 billion euros. They created rules to reallocate profits and obviously, as a result, create extra revenue. And what they also created, because this is what they did with the earlier BEPS rules, they created a multilateral convention, basically making sure that the rules will come into effect, but also requiring countries to get rid of the current digital services taxes that are in place. And I think it was earlier this week or last week, a notification that the US government reached an agreement with countries like France and Italy to get rid of the digital services taxes through a transitional period. And in exchange, the US government will drop the tariffs on certain goods and products from those countries. But in any case, it is going to be effective as of 2023, and as a result, after 2023, no more digital services taxes can be applicable. Now, if you look at the second pillar, and obviously that applies to a larger group of companies compared to Pillar 1. The threshold is 750 million euros global turnover, but Pillar 2 sets a global minimum corporate tax rate of 15%, and that all has to do with, of course, the fact that there's a lot of tax competition through reduced corporate tax rates. And by implementing a rate of at least 15%, the opinion is that there's going to be less tax competition. Now, there are some technical principles connected to the implementation of Pillar 2. There's the income inclusion rule, which imposes a top-up tax on a parent entity in respect of income that is not taxed sufficiently in another jurisdiction. So basically, the parent entity needs to pay the difference in the country where the parent entity is located. There's also a mechanism of an under-taxed payment rule, a UTPR, which basically denies deductions or makes adjustments to make sure that the low tax income is compensated. And the second element is a treaty-based rule, or the subject to tax rule, that allows source jurisdictions to impose limited source taxation on certain related party payments. So it is very important that, you know, I think everybody talked about the mechanism of Pillar 1 and 2. There are a lot of technicalities attached to it, and we expect that in the next, hopefully, few weeks and months, there's going to be more guidance on the specific outcome. And Ayana will also touch upon a US-based case study that has some of these elements attached to it. Now, this is just, a leave behind, how do you make the calculations? What kind of steps do you have to take? It is a first attempt to make a little bit more, make these rules a little bit more insightful. But maybe a little bit more interesting is, how do you deal with all these things and all these changes from a practical perspective? Because there's still a lot of uncertainty, and we talk to a lot of our clients, and it's very diverse. Some clients say, well, let's wait it out until there's more guidance, but there are also a lot of companies that really cannot afford to wait because the outcome could result into certain restructuring or get rid of certain entities, or maybe move things around. And obviously, restructuring always takes time. So if you only can start restructuring on January 1st, 2023, you might be too late. So what we did, we kind of, broke it down into a phased approach. Now, the first phase is really about, collecting information, and you kind of link it to, the country by country report calculations. But you really want to make sure that you can have some modeling around the global effective tax rates under the GLOBE rules. That we already have those principles, but also you want to make sure that you want to assure whether what countries have taxation rights. Now, of course, what is very important, and this is not a discussion started under BEPS 2.0, is of course the whole discussion on intergroup interest deductions, royalty payments, and of course also withholding taxes. And that is something that you really have to map out. Okay, where do we stand today, and kind of break it down into future expectations. Now, I think the second phase, once you have collected the data, you really want to make sure, okay, what kind of assessment can I make? Now, I think that we definitely want to connect to what we see in the country by country reports, but it's going to be a very, gross and rough assessment based on the information and guidance available so far, because there is more to come. Now, the third phase is, of course, how are you going to make decisions going forward? I mean, if you want to think about these things ahead of 2023, you really want to make sure that you have to align it with your global tax structure. You have to align it with your global tax policy. Now, I think other elements play a factor here as well. It's not just like, well, because the effective tax rate is going to go up, that means you can make a lot of, restructuring. There were already some comments on, well, can you make some intercompany payments? Can you shift some profits from one country to another? But of course, transfer pricing is still a mechanism that is to be considered. So there are a lot of complexities into to actually doing something about it. But the approach is really about thinking about, okay, what can we expect? Now, in summary, Pillar 1 is introducing new ways to reallocate and tax income. It applies to M&Es with a global turnover of at least 20 billion euros and a profitability in excess of 10%. Pillar 2 reaches a larger audience. It relates to M&Es with a global turnover in excess of 750 million, and it imposes a minimum tax and certain rules for denial of deductions or imposition of withholding taxes. But I think what also needs to be considered is that countries are also free to apply the income inclusion rule to a lower threshold. So it's not just, well, we are not in excess of 750 million euros and we're off the hook. So it's very important to look at it on a regional basis as well. Like I said, there is a very ambitious time frame to implement it. So we expect, draft legislation by the end of this year, in the mid of next year. And right now, the focus is on implementing Pillar 1 and 2 as of January 1st, 2023. And there are no signs that that is going to be delayed. So we'll have to see, of course, in the course of next year, whether it's really going to happen. But with all the political consensus that has been reached recently, 2023 seems a very realistic time frame. Now, before we move to the next segment, listening a little bit to what I shared, this is more like, well, what do you expect? What kind of global tax issue? And they're not all the same, but what current global tax issue will have the most impact on your business in the next 12 months? So if I'll give you a minute to complete. Oh, okay. Okay. Well, let's see the outcome. I think that went pretty quick. So what current global tax issue will have the most impact on your business? I think a lot of people said, 32% said, well, tax transparency will continue to be a very important part. I think there's a little bit of a increase in the potential Pillar 1 and 2 impact, but not a lot. So that could mean different things. Of course, it is not relevant, or it's still uncertain how relevant it is. Foreign tax audits. Well, we also added here development of a tax governance policy, including ESG impact. That stands out. And of course, transfer pricing documentation. I think that continues to be very important. But of course, you could also include Pillar 1 and Pillar 2 into transfer pricing impact. So with that, we just wanted to leave a couple of thought leadership items, just, personal opinion on how to deal with all these changes. On the one hand, someone wants to get the question back. Yeah, I don't know what happened, but maybe we can start over. Sorry for that. Yeah, maybe I pressed the wrong button. So maybe I want to give other people to add to this. We are at 58%. I don't know, Shannon, can we still get that right or not?
Yes, that's fine, Mario. We'll give him another 15 seconds and then move on.
Yeah. Sorry, I think I clicked the wrong button. Oh, here we go. Yeah. Oh, yeah. Okay, good. You're at 90%.
Yep, we'll go ahead and move to the results now, Mario.
Yeah, okay, sorry. Well, I think that the results have changed not much, although we do have, almost all attendees confirming. I think that tax transparency is about the same, but a third of the audience thinks that tax transparency is going to be really important in the next 12 months. And I think that's very consistent with what we've been experiencing and seeing so far. I would be curious to see, of course, as we get more guidance on Pillar 1 and 2, what kind of impact it will continue to have. But we'll see in 2022, of course. Now I get to the end of my part. Like I said here, I believe that the rules will not just impact, a small group. Pillar 1 maybe a smaller group, but certainly Pillar 2 will reach a wider audience. Also because countries have the right to extend the scope. Of course, the tax legislation will be completely impacted by all these proposed changes. One thing that is kind of left out is the whole discussion on permanent establishment. I believe that on the BEP 7 that takes care of, the definition of permanent establishment going forward, the threshold was already reduced for concluding a permanent establishment. And of course, the new rules on permanent establishment also will impact, reallocation of profits going forward. So that is something that is not going away. And of course, an open door, but still very important. Our recommendation is to start thinking about these changes. There is already guidance. There could be, and there should be, and there has to be more. But I think right now you could already start looking at, some of your low tax jurisdictions, some of your exemptions, some of your exemption systems, and at least start collecting data and modeling out some of the outcomes of the new proposed plans, because there is not a lot of time between now and 2023. With it, Ayana, I will hand it over to you to talk about the U.S. perspective.
Thank you so much, Mario. So yes, as Mario said, I'm going to be talking specifically around the global intangible low taxed income rules and how they interact with the OECD Pillar 2. Before we get started, though, let's go to a polling question number 3, and we'll have 5 polling questions today. So if you've missed if you've missed one already, there are going to be 5 of these total. So polling question number 3, should proposed GILTI legislation be passed, how much do you anticipate your GILTI tax expense to increase by? A, 0%, B, 30% to 50%, C, more than 50%, D, unsure, as we have not modeled out the potential impact as yet. And so, like I said, as you're answering this question, thinking about the second half of the presentation, we are going to do a case study at the end, but we're really looking at how, our rules in the U.S. Around GILTI are going to interact with the OECD's global minimum tax. All right, so I'm going to give a few more seconds here. We're going to switch in 5, 4, 3, 2, 1. All right, and so we have the majority of folks saying that they're unsure as to the impact as they haven't modeled it out yet, and that makes sense. There are quite a bit of folks that aren't looking at the impact yet because the rules have been changing, right? Particularly here in the U.S., we had changes up until last week Thursday. So and more will be coming. So let's get started on the GILTI. So what is GILTI? Just to level set here, the Global Intangible Low Taxed Income Tax was introduced as part of the Tax Cuts and Jobs Act, or TCJA. And GILTI is essentially the U.S. equivalent of a minimum tax on foreign companies. And prior to the enactment of GILTI, U.S. multinationals could defer their U.S. tax on foreign subsidiaries' active business earnings until those earnings were actually repatriated to the U.S., with Subpart F obviously being a notable exception to this deferral rule. GILTI is only applicable to U.S. shareholders, and that's a definitional term in that, it's only 10% U.S. shareholders of controlled foreign corporations, or CFCs. And I'm going to touch on why this is important for planning purposes when we're using this in interaction with Pillar 2, and when Mario and I go through an example closer to the end of the presentation. The current tax rate of GILTI is 10.5%, which is based on the 50% deduction of the GILTI amount. And this 50% deduction is only available to corporations or individuals who make a Section 962 election to be treated as a corporation with respect to certain items such as GILTI and Subpart F. So U.S. shareholders are allowed to take as a foreign tax credit 80% of the foreign taxes that are paid or accrued on GILTI income. So generally, if the foreign tax rate is about 13.125% or greater, there's generally no residual U.S. tax on the GILTI amount. And one thing, I note this because you know that currently the tax on GILTI is about 10.5%. And even if you take into consideration perhaps, you know, the denial of deductions, et cetera, you're still going to be looking at about, you know, that 13% effective tax rate, both of which are below the 15%, you know, OECD rate that the U.S. has agreed to. So GILTI is an annual inclusion, and it is equal to the total active income earned by a CFC less 10% of the CFC's depreciable assets. And this exclusion of 10%, the deemed return on tangible assets, was based on the idea that the location of tangible investments, such as like factories, equipment, machinery, really depends more so on being close to customers, lower labor costs or skilled labor, and the quality of inputs, whether you need, you know, lower type inputs, you know, or high grade inputs, rather than the rate of tax in that jurisdiction. So in contrast, intangible assets are much more easily moved. And so the idea is that tax rates of a jurisdiction are oftentimes considered when locating operations. So the GILTI rules allowed for this 10% of QBI. But this has generated a substantial amount of criticism. So I just want to pause here for a second, because many people have argued that it's really an incentive for companies to shift or locate factories or equipment and other tangible assets offshore in order to maximize that QBI deduction, even if those, you know, tangible assets don't actually contribute to the production of income. The other thing, GILTI is calculated by taking into account all of the foreign income earned and all of the foreign taxes paid by U.S. companies, and so effectively allowing companies to shield income earned in low tax jurisdictions with taxes paid on income earned in higher tax jurisdictions. And this, you know, maintains an incentive to shift profit outside of the U.S. The stated intent of GILTI, you know, the GILTI legislation was really to prevent the erosion of the U.S. tax base, and really by disincentivizing, you know, U.S. multinationals from shifting their profits, right? However, the GILTI rules really have been criticized as having the opposite effect. And this is primarily because of that rate differential that I mentioned, right? The GILTI rate is about 10.5 to that 13%, and, you know, not considering, you know, foreign tax expenses, foreign tax credits, or expense allocations. And that's still half of the corporate tax rate of 21%, right? So there is still that incentive, you know, to push profits outside of the U.S. in order to take advantage of the differential, the difference in the rates. In the spring of this year, for example, Kimberly Klossing presented before the Senate Committee on Finance, and this is something that she stated, was that, you know, we need to, you know, defend the U.S. corporate tax base, and, you know, there's still motivation to shift revenue offshore to tax havens. And she noted at that point that international tax reform is really essential in building, you know, a fairer tax system, and she mentioned it was relatively straightforward. I thought that was interesting. You know, for those of us who work with these provisions on a daily basis, I don't think that we would agree that it's straightforward. But there certainly are several tax proposals on the table, and it is more likely that the international provisions, particularly around GILTI rules, will change. You know, there's only about 16% of the GDP right now that's coming from federal tax revenue. And so these tax proposals are aimed at addressing the need for increasing that amount of revenue. So what I did in the next few slides is really take a comparison and looking through sort of the history of the various, you know, iterations of the provisions around GILTI. As you know, again, the calculation is complex, and so there's room to maneuver various components of the calculation. I'm just going to go through a few of these iterations quickly before settling in on discussion on the Build Back Better Act framework and the OECD Pillar 2. So President Biden's Made in America plan, you know, which was released in April, anticipated that there needed to be changes to the international provisions, particularly around GILTI, so that they could be in alignment with the OECD agreement. As I mentioned, as presently, we are at 10.5%, and OECD's minimum is 15%. So this table sort of gives a comparison of what Biden originally proposed in the Green Book versus what the Senate Finance Committee proposed. And the first thing I just wanted to note was that 20% rate that was originally put out there. We're now down to a proposal of 15%, but you compare that 21% rate. The Senate Finance Committee at the time proposed 60 to 100% of the corporate rate. And if you recall, in this version, the proposal was also to increase the corporate income tax as well. So as to thereby get the increase in the GILTI rate. And then there was also the 10% elimination of that 10% Q by exclusion in that version. Again, I won't spend too much time on this one, but I just wanted to point out that, there was the proposal to raise the statutory corporate rate to that 26.5%, while lowering GILTI income deduction to 50%. At 37.5%. So we're getting it down. You see that we're sort of moving our way down into, 10.5% to, about 16.5% potentially. And also there's that haircut for the foreign tax credits going from 20% to 5%. So you can see sort of the progression of the negotiations that are happening. So I will do our next polling question, number 4. Which global minimum tax legislation will prevail? I don't know if we are betting folks here, but A, no change, current law stands. B, Green Book, or Biden's original presentation of his plans for international tax change. The Senate Finance Committee, budget reconciliation, OECD, or none of the above. And I'll give folks here a few seconds here to respond to that, and then we're going to go into the Build Back Better framework versus the global minimum tax. All right, so we are going to close this out in 5, 4, 3, 2, 1. All right. So we have, I like that, no change, current law stands. All right, and none of the above, but the budget reconciliation is getting the highest amount, but I appreciate that about 20% of us are in the current law stands, So let's move on to the Biden plan, the Build Back Better framework. It isn't depicted here on this slide, but I'm going to speak to it as I go through this chart here, and I'm going to go through this relatively quickly because I want Mario and I to spend some time on that last case study. So this slide shows where Biden was originally at with the Green Book, and in comparison to OECD minimum tax. So first we note that the OECD, Pillar 2 has a revenue threshold of that $750 million 50 million euro, right? And neither the Made in America plan or the Build Back Better framework has a threshold. And one might argue that this puts the U.S., middle market companies at a disadvantage in that, they are, potentially, being subjected to GILTI, even though, they're not meeting that, the OECD minimum tax. So globally, in comparison to their counterparts in other jurisdictions, they may be, taxed differently. Next is the rate. So the OECD requires that countries have a minimum 15% effective tax rate. And in its current form, GILTI is at 10.5%. Which is lower than the agreed to 15%. So you still have that differential. Obviously, that still makes it attractive for U.S. multinationals. At a minimum, they're not deterred from, investing outside the U.S. Again, originally, Biden came out with 21%, much higher than the OECD's proposed 15%. Certainly increasing the GILTI rate to 21% would disincentivize profit shifting. But many, argue that it would be at the expense of the competitiveness of the U.S. businesses. And we did a tax policy webcast earlier in the summer, and I had mentioned there that a 21% rate was really going to be a hard sell for the administration if it was simultaneously advocating for a 15% global minimum tax with the OECD and G20. So with the new Build Back Better framework, we see that the GILTI rate is closer to that 15%, coming in at around like that 15.02%. We know that these are not final provisions, and I think we are comfortable, as Dave Carter mentioned earlier in the week, that tax law changes are going to be coming. And two, international changes are likely going to include an increase in the effective GILTI rate on operating income from non-U.S. subsidiaries. Next are the foreign tax credits, and currently there is a 20% haircut on foreign tax credits related to GILTI income, with no ability, for carryover. Sorry, and this is really a jagged pill to swallow. And so in the Build Back Better framework, you'll see that haircut was lowered. So now 95% of the GILTI taxes are allowed. And for the OECD, they are allowing, the full credit for taxes. The Made in America plan proposed to eliminate the 10% QBI exclusion, whereas the OECD Pillar 2 includes an initial 8% QBI exclusion. And the Build Back Better framework also allows for a 5% QBI exclusion. So you see we're moving closer to what the OECD Pillar 2 model looks like. And this is going to be of particular importance for those, that have a lot of tangible assets in, consumer products, industrial products, for example. One notable difference is that there's a payroll exclusion contained in the OECD tax, minimum tax. And that is not in either of the versions, and certainly not in the framework that came out last week. And this is probably primarily due to the fact that the objectives of GILTI and the OECD minimum tax are a little different, and the players are a little different, right? So GILTI was enacted as an anti-deferral measure, and it's meant to simply tax excess profits, right, derived from intangible assets outside of the U.S. But in addition to this objective, the OECD has countries in there that have lower corporate income tax rates that are used to attract foreign direct investment, but are still not tax havens. So this point here is really critical to countries such as Ireland, that have that 12.5% corporate income tax rate. Loss carryovers with respect to the GILTI tested losses. The original Made in America plan did not allow for such losses. However, the Build Back Better framework does allow losses in a limited fashion, which is in line with the OECD. And of course, the big one is the country by country. As I mentioned earlier, in its current state, GILTI is calculated in the aggregate, and so low tax and high tax income can be combined. And under the current aggregation methodology, right, there's opportunities to blend and shelter income and expenses and credits from various jurisdictions to minimize GILTI. So arguably one of the most consequential changes is this country by country calculation. The Build Back Better Act framework is consistent with Biden's Made in America proposal, which also shifts the GILTI calculation to that country by country calculation. So with that, we're going to go to our long-awaited example. So, there's still no consensus on whether GILTI can truly coexist with Pillar 2. However, Treasury Secretary Yellen said that, they're going to continue to work with Congress to include provisions that are in line with Pillar 2. But based on what we've seen so far with that Build Back Better Act framework and what we have from the OECD, Mary and I think an example would be helpful to show how the two could possibly interact with each other under various fact patterns. So here's a simplistic example that depicts a U.S. multinational which owns interests in non-U.S. subsidiaries, and one of which is a CFC and one is a 1050 company, meaning that the U.S. shareholder owns at least 10% interest, but the U.S. shareholders don't own more than 50%, and it's therefore not a CFC. So we also depict some intercompany transactions going between the U.S. and the non-CFC subsidiary. and the non-US subsidiary has an effective tax rate of less than 15%, I think 12% here, right? So what are some of the considerations when looking at the application of GILTI and Pillar 2? And it's helpful to break it down into, the CFC versus the non-CFC. So with respect to the CFC, that U.S. shareholder would be subject to the GILTI rules, right? And assuming that we get GILTI at that minimum 15% effective tax rate, then the U.S. shareholder would only contend with the GILTI rules and would satisfy, Pillar 2's income inclusion rule, the IIR or the top-up tax, right? And if you recall, there is a threshold for Pillar 2 to apply, the $750 million euro. But Mario, what are your thoughts around not only the IR, but the potential compliance obligations that U.S. CFC would have? Like, for example, do you think the CFC would have to show documentation? I know that Grace mentioned earlier that they really are trying to, keep the compliance, down to one entity in the structure. But, maybe just get your thoughts on this before we jump into the non-CFC subsidiary scenario.
Well, I'm not that optimistic. I do know, they mentioned it, but I think what we have seen so far is actually a huge increase of the compliance burden. And I think, but this is maybe very practical. You also have, countries filing taxes in different in a different tempo. I think in the US. Companies are probably way quicker than most of the countries in Europe filing their tax returns. Obviously, we have the preliminary assessment, so governments will get their money. But I think in terms of filing, the US is much quicker. So I definitely think there is going to be a need for documentation. Just looking at the site, someone raised the question of, does it apply to a US company plus foreign sister companies? Yeah, and it's a global threshold, right? So all the companies and entities count. It's not just the U.S. company, but it's the global turnover. But Ayana, to answer your question, I think there's a lot of, especially in the first 2 years, I think a lot of companies will not take the risk. The practical consideration is, of course, how would the local government deal with, all that information or information that is not shared?
Right.
I think we've also seen it's a different context, but if you look at DAC 6, for instance, there are high penalties. So a lot of companies, and obviously we advise them also to do that, but then you see that governments really struggle with processing all that information in terms of, okay, what do you get out of it? Huh? So unfortunately, yes, I do think that there is more compliance burden than promised.
Right. No, that's an interesting insight. Moving, I know we only have 5 minutes here, so let's, we can go to the non-CFC context. And you and I talked a little bit about this last night. In this instance, in this 1050 company here, GILTI is not applicable as the entity is not a CFC, right? So from a U.S. perspective, because we no longer have the Section 902 credit, there's likely no ability to get a foreign tax credit for the local corporate income taxes paid by that 1050 company. So, maybe we consider check the box planning, to treat the 1050 company as a partnership in this scenario. But, obviously we'd have to model that out. Another consideration is the effective tax rate in this example is less than 15%. And so as a result, the IIR would not apply. And so the 1050 company in this example would be subject to the undertaxed payment rule, the UTPR, which could potentially deny deductions. And another consideration is that, there may not be a dividends from a U.S. perspective, a dividends received deduction under Section 245A on repatriations up from that 1050 company. So what I did like, I like it now. When I probably model it out, I'll let you know if I still feel this way about it. But, the Build Better Act framework does allow for an election for foreign corporations to be treated as CFCs. And that would allow the benefit of the Section 245A dividends received deduction. But it would also mean that GILTI would apply. So in addition to the benefit of the dividends received deduction, the minimum tax requirement would be satisfied because guilty would apply. But again, we got to model this out. So Mario, what are your thoughts? I know we're at 3 minutes here, on the application.
Yeah. Well, thoughts or questions, but I think one thing that stands out in respect of the time, but obviously with the U.S. system of checking the box, I think all kinds of foreign problems are to be considered because of a lot of hybrid legislation.
Yep.
So I think we used to kind of say, well, that's a U.S. matter, so we don't really care if they say check the box or not. Sometimes for treaty purposes, but now with all the hybrid legislation and actually like the updated legislation kind of dealing with all these U.S. elections, I think that is a layer of complexity still to be considered, because we talk about the effective tax rate. But I think the elections may cause a lot of problems from a foreign perspective. And I think that's something that, really needs to be addressed as well.
Yep. Yeah, modeling is going to be so incredibly critical, and we really wanted to just work through this example with you so you can see that there's so many different layers and so many different parts that are interplaying together. And, Mary and I could sit here all day and do this, but let's move to our last polling question number 5. Would you like to talk more about this topic with an RSM professional? Yes, A, yes, or B, no. And Mario, while our listeners answer the last polling question, I don't know if there were any other questions that came through the Q&A that you'd like to address now.
No, I think we covered all, and I think we have to really start the end, I guess, with 1 minute left. Yeah.
Awesome. We did it, right? Well, thank you so much for joining Mario and I today. I'm gonna close the polls here. We are going to be in the networking lounge for a discussion afterwards. We hope that you found this as enjoyable as we did. And back to you, Allison.
Thank you so much, Ayanna, and thank you to Mario as well, and to our audience for joining us. As Ayanna mentioned, they will be in the networking lounge. You can click the link in the resources list to the right of your screen. We have, of course, provided a number of other resources that you can download at this time or return to the webcast platform to download as well. If you have met CPE criteria, you may download a copy of your certificate by visiting the Certification Center and clicking the download icon. Be sure to save a copy to your computer in the next few minutes before we conclude our event. Smartphone users can download their certificate from any computer at a later date using today's webcast link. Thank you so much for joining us, and we look forward to participating in this afternoon's discussions for RSM Tax Summit 2021. Have a great day.